Hey everyone, Doug Masters here, and today we're diving into one of the most exciting trading patterns that people often get wrong. If you can read the chart, you'll always know what to do next and trade profitably, so this video will be super useful. Today we're breaking down a pattern commonly known as the flag. But before we jump into the practice, let's cover a bit of theory. A flag is a chart pattern that confirms a trend. Flags appear after a price surge or drop when the trend temporarily weakens. On the charts, we're seeing two variations of a trend. When the trend forms a flag, the price moves within it. For instance, consider the massive flag pattern that Bitcoin has been stuck in for 600 days since its drop to $16,000. When the flag serves as a consolidation zone preparing for the next move along the trend. Picture this, multiple more miniature flags inside that more significant 600-day flag, each pushing the price higher and higher. So, flags are split into two types based on their role. Number 1. Bullish flag. This looks like a downward sloping parallel channel. It allows one to accumulate positions within a specific range, setting up for the sweetest long entry point. The idea is to capture the maximum percentage gain as the price increases. Typically, this pattern breaks upward with target levels at half the flag's height and then a full move to the previous high, essentially the flag's peak. Bearish flag. Here we've got an upward sloping parallel channel. The goal is to guide the price to an attractive short entry point, allowing traders to maximize their profit on the way down. This pattern usually breaks downward with targets at half the flag's height and then a full move to the previous low level, essentially the flag's bottom. Here's a golden rule to significantly boost your win rate. Always trade in the direction of the trend and trade each trend as if it will never end. This means that in any trend you buy at the lower support of the flag and sell at the upper resistance. For an upward trend, enter a long position at the lower level and close it at the upper level. In a downward trend, open a short at the upper level and close it at the lower support of the flag. There are two flag trading strategies. Number 1. Breakout entry. This is the riskier option. Enter on a breakout above resistance with a stop loss just below the flag's lower level. The stop can be quite large, making the risk-to-reward ratio less appealing. In this case, targets are half the flag's height and the previous high. Number 2. Lower level entry. You enter near the lower level with a tight stop loss. Close 50% of your position when the price hits the upper level. Set the stop loss to break even and let the other 50% right to the full pattern target. This strategy offers a much more attractive RR, allowing you to move to break even and profit with a minimal risk quickly. Now let's move from theory to practice. Trading. As usual, we've chosen Bitcoin USDT pair. Let's take another look at how to spot a flag. On the chart, you'll see a rise, consolidation, and then a breakout. Let's draw it out. Here's the flagpole shooting upward, followed by the flag's body, which fluctuates between resistance and support levels, and then the price shoots up again. Flags often appear one after the other, and in my experience, they usually result in about a 15% move either up or down. We just looked at a bullish flag, so now let's check out a bearish flag. Here we see a downtrend, a breakout, a slight upward move, and then a sharp drop. You can also see a clearer flag on higher timeframes. Now let's dive into how to find a flag on the chart. In TradingView, the go-to tool for traders integrated with any exchange. There are several ways to spot a flag. Let's switch to the higher timeframe, like 1 day or 4-hour chart, and zoom out. What we see are impulses, those sharp vertical price movements. Between these impulses, we have periods of consolidation where the price settles within a specific range. This is often where a flag pattern forms. Remember, a flag is a zone where big players accumulate positions to continue the trend. So we identify the trend and enter trades in that direction. Long in an uptrend, short in a downtrend. When a trend is already made up of two impulses with a consolidation phase in between, the flag can also act as a potential trend reversal zone, serving as a range where the market gathers strength for the next price move. To wrap it up, the flag is an excellent pattern for using a pending order strategy. The idea is to pinpoint the optimal entry point by setting a pending buy or sell order. Just keep in mind that the pattern can also be false, so it's wise to test the market first and avoid going all in right away. And remember, technical analysis patterns don't guarantee 100% success, and market makers are always present, but we'll cover them in another video. One last tip. Track flags on higher time frames because they can behave unpredictably on lower ones. Plus, it's easier to confuse them with other formations. I hope you found this video helpful. We're going to keep bringing you more and more insights into cryptocurrency trading every day. Thanks for sticking with us, friends.